So I'd like to welcome everyone to the Bybee education. Pleasure to be with you today. I'm going to go ahead and I'm going to close those out. And I'm going to do it all over again. I've seen a couple questions talking about placing trades. And what I wanted to go over today were some of the basic information for you, just so we can be on the same page and be ready to go. Give me a quick second here. And we will get going. Alrighty. Okay. So let's get started. Make sure you guys can hear. Okay. A lot of questions came across to me in the past week about placing trades. Man, I want to get started. I want to go make some money. I want to do what I can do to be profitable. I understand that. I'm going to make one pitch to you to spend a little more time learning the information so that when you place a trade, you're going to be profitable and you're going to be good to go. I want to go over our paper trading account with you for today. Right now, we are literally up $2,300. Since we started this, market's been down about 3.5%. You're up $2,300. Just doing the simple math, you're 2.3%. Market's been down 3.5%. You are beating the market by about 5.8%. You are profitable. When the market's been down 3.5% since we started this little paper trading account, you guys are literally profitable $2,300 in a market that if you had an index fund or something that followed the market averages, you guys should be down about $3,500. Pretty cool to be able to make money in any direction that the stock market moves. Now, I want to go over these positions, again, the basics for you, and I want to spend a little bit of time going over what these positions are, the covered call, the long put. Emily, just as a heads up, I just sent you out a phone number so you can call me anytime and we'll spend the time going over your stuff. We have a short put. We know it's a short put because of the negative sign. Short put means between now and the third week and Friday, we are obligated to buy Disney at $100. So if we're obligated to buy Disney at $100, let's work on our break even. We took a credit in of $38.88. Disney has their earnings on the 9th of February, which should be not this Wednesday, but a week from Wednesday. If I do my math, I have to buy it at 100. We took a credit in of $3.88. It should mean your break even is at $96.12. anything above $96.12, you are profitable. Where is Disney trading at right now? Are you profitable? Disney's trading at $95.03. $95.03. Boy, I should have used my other one. So if we do the math on this one, literally, last time it was 75 cents, but you you are going to be down $1.09. Is that a big deal in the scheme of things? Not really. Not really. It's not really a huge daughter. Huge daughter. Huge difference. It's a covered call away from being profitable. We have earnings. My expectation is you'll probably see Disney go up to 100. So to take the risk off the table, if we see Disney up at 100, because of the time that we've been in this short put, we're going to see that price go down. And as that price goes down, we're going to lower our cost basis of the option. What we sold for $3.88, we're going to get to buy back for maybe $2. We'll make $1.88. Right now, we're sitting pretty good in Disney. Ford, we are not sitting so well in. In fact, Ford, our true cost basis is about 48 cents. We have the right to buy Ford at $12.75 between now and March. Well, dang it, Ford's trading at $1.90 or $11.98. Let's do the math. Sorry, guys. I don't know what that is, but sometimes I do a two-finger sweep, and it makes my computer switch into this mode. I kind of feel foolish that I don't use, I don't know, I don't use an old-fashioned mouse. It just don't like it. There's both my go-to meetings there. You can see that. Should have got off the old one. Okay, here we go. Back to our spot. So let's do our break even. Well, we have the right to buy Ford. It's a long call. We have the right to buy Ford at $12.75. It's a right. We purchase rights. You'll see us talk about buy to open, sell to open. Long calls, you buy to open, which means you're spending money. It's a debit trade. Well, in this one, we spent 48 cents. So our break even, for us to make any money, we need to see Ford trade higher than the $12.75 plus the cost of the long call. Anything above $13.23, we're making money on our long call. For those that are here today, Emily, Jeff, Keeve, and Steven, what do we do with our long call if Ford is only trading at $13 a share? If by the third Friday in March, Ford is only trading at $13 a share, what do we do with our long call? Jeff says let it expire. Ooh, Keith's thinking outside the box. Extend time or let it expire. If you think Ford's going to start moving, it just didn't happen between now and March. Keith says, hey, it's going to happen in April or May. People buy cars before summer to go on their summer trip, right? I like it. One other thing you can do, both those are fine. Jeff, if you still had 10 cents here times 10 contracts, which is 1,000 shares, right? Got to do your math, but 10 cents times 1,000 moves the decimal point three over. You might still have $100 left in it. You might choose not to. You might choose not to be in to let it expire. You might choose to. You might choose to sell it and collect whatever premium is left over. When you say if you had 10 cents, what does that mean? That means that that plain and simple, you still have, it still has a value to it. It's still worth something. It's still, there's still time that maybe things can change. So that 10 cents is extrinsic value, extra value, and it's giving you the opportunity to say, hey, I can let that 10 cents expire, or I can keep it, and you have that opportunity to keep it. Well, you have the opportunity to capture what's left of it. So you could sell that call to someone. Correct. There could be someone else that wants the right to buy the stock at $12.75 because they have the right to sell it at $15. So you might be filling someone else's trade that already has a position. So that, and actually, I'm going to go ahead, I'm going to erase all this. Right now, the mark, the value is 19 cents. So if you take that 19 cents and multiply it by 1,000, that is still worth, literally, that is still worth $190. Between you, me, the fence pole, et cetera, at $190, I want to hold on to that. I don't want to just let that expire. $190 could be like 4 rounds of golf for me. It could be 2 dinners to feed my family at the Olive Garden. So, it is true you can let it expire, but Jeff, all I'm saying is take a peek. If there's anything left in that, as long as the bottom line is worth more than the cost of commissions, you might want to get some of your money back. Just so you know, and just so you're going to be okay. What would that commission be on that? For Options House, it is like $4.95. So per trade, correct. So for me, as long as this number is bigger than $4.95, then I'm good to go. And for stock, it's like $7.95, but I can do unlimited shares of stock. And it's per trade, Jeff. It's per trade. So that's how I calculate if I'm going to be okay or not. How much did the call cost in the first place? Well, the call cost in the first place, 48 cents. So that really the call in the first place cost $480. We are down. We are down in the position. Correct. So what I spent $480 on is now worth $1.90. I'm losing $290 on that trade. Not any fun. But the good news is we have it all the way out to March. We have it all the way out to March. We're doing okay. All right. Let me go to Visa. Visa. We did a covered. Okay. When we first bought Visa, we bought Visa at 73.16 basically. We shorted a call for 56 cents. So when we short a call, we plain and simple, we're obligated to sell our stock at a certain price for a certain period of time. We took in a 56-cent credit. What did that lower our cost basis to? Perfect. 72.20. Excuse me, 72.60. Jeff, Keeve, Emily, who is Ellis married to? Who is Ellis married to? Don't you guys have a sister or a daughter-in-law? Ellis is my niece. All right, Jeff. Just as a heads up, if you can let her mom or dad know, she just accidentally ran into the back of my wife's truck. My wife is okay. Her back's a little sore. Heather's okay. Elise is okay. But it did deploy her airbags to her car. Again, she's okay. My wife has been texting me as we've been doing this. So if you've heard me, she, I'm assuming, is over here in Alpine. But the airbags have deployed in her car. She ran into the back of my truck. Everyone is okay. I'm not so sure. I'm not so sure what she's going to do with the car, though. Who was driving? I'm going to assume it was Elise, E-L-L-Y-S. My wife typed it E-L-L-I-S. and apparently there are police that are there. So, but everyone's okay. You just might want to give a quick text out to her, and they might need a little bit of help getting the car home because the airbags were deployed. And no, we're not going to try to sue you for millions of dollars. All right. All right, off to the next. So, if you guys can send out a quick text just to have her call her daughter. Apparently to Andrea, she's a little shaken up. She's not hurting anyway. They weren't going fast, but those darn airbags deployed on her. Okay, going to Visa. We've got a cost basis right now of $72.60. We've gotten through earnings. Let's see if we can't sell another covered call. We sell to open. We sell to open the position. So what I do, and I almost want to feel we need to get you guys involved with Options House. But for me, I go and I click on the Visa and I click on the options. I'm looking at options and I'm thinking, you know what? Pretty cool. I can take in $1.58, $1.31, $1.07. I can take in, I'm going to choose the $1.30. I want $1.30 of credit. So I am going to sell to open. A February 74.50 call. When you sell to open, it's a credit. How do you know? It's the action. You buy to open, you sell to close. No matter what broker you use, it'll have a buy to open, it'll have a sell to close. So, somewhere in there, for us, it's going to be a sell to close. It's going to be a sell to open, so we take in a credit. That sell stands for short, S stands for short. The buy, you're buying a right, you're selling, you're obligated. And dang it, I want to make $1.29, so I'm going to preview it. And off I go. So I go to my orders. And I'm waiting for it to get to my $1.29. Now, because this is just a paper trading account, I really don't care. I can pull it down to $1.27. I'll resend it there, and it'll probably get filled pretty quickly. And you can sit and you can watch it get filled. The short answer is I'm going to assume we're going to get $1.27 of credit. So let's go back to our positions. I already know, right? Emily, is one the call and one the put? Yes. In fact, let's go back to that option chart one more time. Calls are on the left, and they have, for this particular broker, calls are on the left, puts are on the right. And you sell or buy with a market limit order when you do that. You can do a limit order, you can do a money order. It doesn't matter. There's no right or wrong way to do it. I just chose, you know what? Let's make it, but I'm losing money on it. I just let it sit. Let's sit and say I can't get $1.27. The problem with the limit, it will not sell it till it gets that $1.27. Well, of course, the stock is falling. So when the stock is falling, I'm not going to, right now I'm only getting $1.21. So the bid and the ask, you always sell at the bid, you buy at the ask. When you're selling an option, you're bidding it out to get your best price. So when you're selling an option, it's always done at the bid price. When you're buying an option, you're asking someone if you can buy it. So when you're selling an option, you're asking someone if you can buy it. And so you buy it at the ask. Kevin, there is a difference in price. There's a difference in price there. Of course there's a difference in price there. And in this particular one, there's a 3-cent difference in there, right? So somewhere in there, you have a moneymaker. Someone that is going to say, hey, I'm going to fill that order, and they've got 3 to 4 cents to play with. They've got 3 to 4 cents to play with. And by the way, my wife just texted me. It is Nicole's. That's not Ellis. It's Nicole, and I'm pricing that extremely wrong. She was driving. 2 women with little kids. In fact, Ellis is probably meeting Heather. 2 4-year-olds are going to become lifelong friends because of a little fender bender. So that difference in price there is the little wiggle room that a moneymaker, someone that has and is brokering calls and puts back and forth, someone they have to make a penny or two on the transaction. And so it sits in that price range. Emily, are you okay with that? So here's our expectation. We've already sold one covered call. It's lowered our cost basis down to $72.60. We are trying to sell another one for $1.25. That should lower our cost basis down to $71.35. Kevin, what happens if Visa goes up past $74.50? Well, I am then obligated to sell Visa at $74.50. I have the shares. I've got 500 shares right here. I bought them at $73.16. I'm in pretty good shape, but let's work our true cost here. If I'm obligated to sell Visa at $74.50 because of the 2 credits, right? 2 credits, my cost basis is down to $71.35. Looks like I'm going to make $3.15 a share. Well, Kevin, $3.15 isn't that much money. Of course it's not, but it is times 500. So it'll come out to be, what, around $1,575. But if I take that $3.15, excuse me, and I divide it by that cost basis of $73.16, let's do the math. 315 divided by 76.15, hey, that comes out to be a 4.2% return. You just made a 4.2% return on a stock market since we placed this position that's been down almost 6%. You're beating the market by 10% on Visa. Not a bad return in a market that absolutely sucks. That's unpredictable right now. We have another question that came in. But how does that happen? Well, how that happens is market closes on, well, let's go get our position in there so we have it. Let's go to our orders. Let's just change this one. Let's modify it. Let's make it a market order. And it'll get filled really quickly. Boom. It's filled. So, here in 3 weeks, on the first Friday, the third Friday of the month, a lot of action is going to happen around Visa. If Visa is trading at $75, on Saturday, all of these disappear. On Saturday, your broker says, hey, Kevin, you're obligated to sell your Visa shares at $74.50. So they're going to take these shares out of my account, and they're going to say, hey, Jeff had a long call and has the right to buy Visa at $74.50. They're going to take these 500 shares out of my account. They're going to go put them in Jeffrey's account on Saturday when the market's closed. And on Saturday, Jeff can look in his account, and he's going to have shares of Visa at $74.50. For me, that's going to create a profit of roughly $1,575. For Jeff, if the shares open up on Monday at $75 again, right? Say on Monday when the market opens at 75, this position already will be up 50 cents on 500 shares. He's going to be up $250. Now, what Jeff has to do, Jeff, if you had the right to buy Visa at $74.50, you paid for that right. The question is, you got to subtract out of this profit, how much did you pay for these calls? Did you, hate it when I do that. This stupid freaking computer ticks me off. I got no idea what double finger swipe I'm doing on it, but it just ticks me off to no end. Not any smarter than a stupid computer right now. All right. Thank you for dealing with my ranting and raving. If we ever get on some type of game show, tell me something that really ticks Kevin off. Now all you guys know exactly what it is. It's computers. I need a computer that just I can look at and I can just tell it what to do and it'll work 100% of the time. So the question is going to be, Did Jeff pay $1.20 for it? Did he pay maybe 50 cents for it? Jeff, you are going to have to subtract out of your profit what you paid for the right to buy it at $74.50. These are good questions. If you guys have these questions, go ahead and ask them now. So then you lose your shares because you were called out. Perfect. I'm going to get called out at $74.50. And guess what? I'm going to make a profit. Could I have made more of a profit? Possibly. Could I have waited a little bit longer and held on to that limit order and sold it for $1.27? Yep. I'm already down. Geez, I'm already down 11 cents. Could have held on, could have waited a little bit longer. Not a big deal though. Not a big deal at all. But if you get paid for it, you can use the money to buy another shares if you want to. Correct. I can initiate another position. I can get called out, take my profits, and I can start the position all over again. There are a lot of things you can do. The neat thing about options is you know, no pun intended, but it gives you the option to do a lot of different things in the stock market. And one of them is to make money up, down, or sideways. All right, a couple questions here. Let's go through. I'm going to go through one more time. I wanted to review what was taught to you by Jeffrey last week. The covered call is a short call in stock ownership. One more time, you never, ever, ever, never, ever, 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 ever sell a short call without a long call or stock ownership, which means when you're selling short calls, it will be a debit trade. You will never be able to make up the short call the short call credit will never make up the cost of your stock. Really, if you are selling a short call and it 100% pays for your stock ownership, there is a problem. That is your first red flag. Hey, there's a problem here. We've got to do something. You have that long stock. You bought the stock. Long equals you bought the stock. When you buy the stock, a short call is placed after you purchase the stock. Usually it's placed at the money or just out of the money in the current month of options expiration. What does that mean? If you remember from last week, that chart, right? Options decay. Options lose value. They lose a little bit, they lose a little bit, they lose a little bit. Then at that 30-day mark, right? At that 30-day mark, boom. There's some big movement, some big time decay on that option. You guys like selling a car for $10,000 and have it being worth only $1,000 a week later. How cool would that be to every week you could sell a car for $10,000 and buy it back a week later for $1,000? Pretty neat. You'd make $9,000 each time you did that. If the stock moves up in price, that short call is going to be exercised against you or will be assigned. What does that mean? Well, the short call, your rights and obligations. You're obligated to sell your stock at a certain price for a certain period of time. As we went over Visa, right? As we went over Visa, you're selling Visa at $74.50. When your cost basis is at $71.15, you're selling Visa at a higher price. You're in great shape. Where did you get that 71 from? 2 covered call credits. Cost of buying the stock. Buying to open Visa. If the stock moves down, if it never gets to that 74.50, right, that short call strike price, if it never gets there, then it's out of the money. If it expires out of the money, you get to keep that full credit. That $1.25 or $1.20 I just sold, I get to keep that credit for a second time. It lowers the cost basis on your stock. And what are you going to do? When that expires worthless, what are you going to do next? When that short call expires worthless, no one else can obligate you to do anything else. Correct. When that short call expires worthless, no one else can obligate you to do anything. It's expired. It's done. Their obligation on you is over. So if it's over, what are we going to do again on the third Friday, like the 16th of February? What are we going to do the following Monday if our obligation is over and it expires worthless? Hey, Dave, pleasure to see you. Nice to have you here today. What are we going to do if it expires worthless? What are we going to do if this February 74.50 expires worthless? If you look at the history, right, buy more stock. We're probably not going to have enough money to buy more stock, but we had one expire worthless already, right? We took a 74 covered call on the 11th, and guess what? It expired worthless on the 15th. We got to keep this 54 cents. We just sold right here, $1.21. What's going to happen on the 16th? It's going to look exactly like this if it's below 74.50. So, Jeff, you're exactly right. We're going to sell another covered call. Let's lower our cost basis by another 121 again. Maybe let's lower it earlier. When I was talking to myself, I sold one for 120 earlier today when I had the wrong link for the go-to webinar. So, short answer is yes, we're going to sell another one. We're going to sell another one to continue to lower our cost basis down. Can you extend an option? Yes. Let's say, for example, the stock price is 74, right? And that's at 74 on the, let's say it's 74th on the 19th of February, which is the third Friday, right? Well, I'm not going to be called out. You know what? Let's put it at 74.55. It is higher than 74.50. I am going to get called out. I'm going to lose all my shares. It's all going to disappear. Kevin, I think Visa can go up to $80 a share. Well, I think so too. So if it's trading at 74.55 on the third Friday of the month, which is going to be the 19th of February, I can buy back this option. It's called a roll. I'm going to buy it back. It'll have at least 5 cents, some time value. It might be worth 15 cents. Emily, are you okay for buying something back at 15 cents that you originally sold for $1.19? If you could sell me a Visa contract for $1.20 basically, and then buy it back for 15 cents a couple weeks later, are you okay with that? Are you okay with buying back your obligation for much cheaper than you sold it to me? Heck yeah, Kevin. If I can make $1.05 on you each week times 500, if I can make $500 on you, $525 a week on you, selling you something for $1.20 and buying it back from you for 15 cents, cha-ching, you're making money. You're all over that. So what would we do? Hey, it's in the money. I don't want my stock called away. Pretty neat. It's called rolling the option. What you're doing is you are closing the position. So you're buying back your February call. And at the same time, you are selling a new one. Farther out in time, I would probably be choosing March. And you're going to end up getting more credit. You're buying back your old one, which is a debit. You're selling a new one farther out in time at 50 cents higher price. I wonder if you could do it at the same strike. No. At 50 cents higher, a month out in time, you're going to get another credit. And you can just keep doing it over and over again, month to month to month to month. It's called a covered call strategy. You do have to spend a little bit of time calculating your positions. Cost basis is the net debit of the trade, which is the cost of the stock, the original purchase price, minus the credit of each short call that you sell. Maximum risk is the cost basis. Your risk is basically what you purchased your stock for minus your credit. And that credit is a relatively small credit. Don't forget, last week was trading at $74 today, was trading at $70, $69 last week. So the covered call is not protection. It is nothing more than a little credit to give you some time to make a decision if you need to add that long put on for protection. Very interesting comment here. Can you go over worst case scenario with a covered call trade? Certainly. Visa goes out of business. They have a bad CFO, and the CFO has taken their cash on hand. Not only can they not buy Visa Europe, but he put all this money that they were making into derivative trades. They've got no money. They can't pay their bills. Visa goes bankrupt and goes out of business. Well, we bought the stock. If you don't mind, I'm going to go to a pen. We bought the stock at $73.16. We lowered it by 56 cents. We have a second one that we lowered it by $1.20. Our overall cost basis is $71.35 per share of Visa. We had 500 shares. We still have a risk And the risk right here, the risk is the cost basis, 71 times 500. We've got a risk of literally $37,000, $37,500 in this trade. If the stock went crazy and went out of business because their CFO took all their money, made a hedge, made a bet, lost badly, they've got no more money, they can't pay their employees, they're going out of business, you've just lost $37,500. It looks horrible. It would be horrible. It'd be ridiculously horrible. That's why the covered call is never protection for a stock. Yeah, you've made up $2. You made up 4%, which means you still got 96% of your total invested capital at risk. Scary. Good question, Jeff. Maximum reward, difference in the strike prices. If you sell it at a higher price than you bought it, you make money on your stock, and you get to keep that covered call when the stock gets taken away from you. It's funny because Jeffrey says a good target ROI is 1.5%. Well, we're going to be in this basically about 2 months. For 2 months, we'll make a 4.2% return on Visa. Divide that by the 2 months. We're right in the range of a 2.1 per monthly return on Visa. Not a bad position to be in. Now, have we been down more than this during the time period of owning Visa? Of course we have. Dang it, the stock lost 10% of its value. We only made up 56 cents for a while. Yes, for a while we were down 9% on freaking Visa. Hey, we're in great shape though overall. Last but not least, good target time is 45 days. I'm going to tell you a good target time is 30 days or less. 30 days or less, and you have time decay working in your favor, you're in a good trade to get out relatively quickly. Now, a couple questions came up. Keith, 2 sessions back, you asked, what about the Netflix long put? That is our protective put strategy. We closed the Netflix put for a profit. We had a big move down. We bought to open the position. We sold to close it. We made about $1,900 or $1,800 on Netflix. That part of our trade is over with. Keith, if you go back 2 sessions back, I go over the closing of Netflix. We still have our other positions that are open. Emily, so you need a long call with a covered call, a married one? Yes. For the short put, the short call, anytime you short a call, you have to have a long call or stock ownership. You never ever short a call by itself because that short call has unlimited risk. What if you shorted a call by itself on Visa at $75 and they entered China and tripled their money? What if Visa over the weekend went from $75 to $250 a share? You would be buying Visa at $250 to turn around and be obligated to sell to someone at $75 a piece. You always have a long call or stock ownership when you want to sell a call. You need something to protect your risk on that trade. Jeff, so this particular trade makes money as the stock increases in price. It can make a little bit of money as the stock increases in price. Ideally, you want a flat moving stock. A covered call makes money if the stock goes sideways or goes down slightly. It can make you money if it goes up slightly, depending on where you put it, like Visa, right? But the short answer is, if I go ahead and I use Visa one more time for that short call, Visa makes a little bit of money as it goes from 74.50 or higher, because you get an increase on your stock and you get an increase on the covered call. If Visa goes sideways and stays at 74, you make money on the covered call. Now, if Visa goes down and your break even goes to what, 74, 72.80, right? Anywhere between that 74 to 72.80, you're going to make some money on that covered call. But if Visa goes below 72.80, you're losing more money on the stock. So the short answer is, you have a small window, 72.80 to 74.50. That's your make money on the trade. Anything above 72.80 is a profit for you. Anything below 72.80 is a loss. All right, let's go over our protective put. We just found out covered call, 90% some odd risk in the trade. I don't want that much risk in my position. Well, a protective put, what do you think that put is protecting? What do you think that put is protecting? Cost of stock. There you go. That protective put is giving you the right to sell a stock at a certain price for a certain period of time. You buy the stock, you buy that long put as close to the money as possible. If the stock moves up in price, the long put is losing value. That long put is your insurance on your stock. If I go back to Visa, let's find some real numbers. Let's find some real numbers on Visa there. Go to Visa, go to some options. We definitely want to go out to March. We want to go out 30 days or more. Usually it's 60 to 90 days. So if we go out to March, I want to protect Visa. It's trading at 74.46. I would choose to protect it at 75. It's a long option. You are buying to open, which means I'm going to spend $2.80 to give myself the right to sell Visa at $75 for 47 days. Let's work those numbers. Let's work those numbers to give you an idea just how much we're protecting. I bought Visa back at 73.16. I lowered my cost basis by 56 cents selling a covered call. My cost basis right now is $72.60. I'm going to buy the right to sell at 75, right? I'm going to protect it. Our stock market sucks. We need protection. It cost me $2.80. That is a cost on your stock. If I do my math, 4, carry the 1. My new cost basis is $75.40. For the next 47 days, I will have the right to sell Visa up at $75. Someone please do the math. What is my risk on Visa if I buy a long put, a protective put? Bought the right to sell it at 75, have a cost base of 75.40. I've got 40 cents per share at risk. If I do my math and go 40 cents divided by 75.40, yeah, I've got a 0.5% of risk in Visa because I've bought the right to sell Visa at $75. Keeve, I've calculated in, I've added in my new cost basis. But the neat thing is, my stock has gone up. The covered call, that covered call credit, I got to keep. As of today, I've lowered my cost basis down to $72.60. Add in the cost of protection, my new cost basis, right? New cost basis is $75.40. I've got the right to sell at 75 out to the third Friday in March. That's 47 days. I've only got 40 cents of risk times 500, and I've got $200 of risk on a $37,500 investment. That's awfully darn good. That's how you beat the market over time. Looks like I have missed a comment. Nope. Dave, that's just Dave saying hi. All right. Let me go over one more time. Protective put. You buy that long put as close to the money as possible. It gives you the right to sell a stock, which means if the stock moves up in price, your long put loses value. If the long put moves down in price, it gains in value. Cost basis is the cost of your stock plus the cost of the put. Maximum risk, cost basis minus the strike price that you have bought the right to sell your stock. Maximum reward is unlimited. Visa can go from 75 up to 250. There's no short-term target. That married put is used, or that long put is used to protect your stock ownership. What does it look like? Here's the key to that long put. You might buy the stock at $100. In this example, where are we going to buy the right to protect our stock ownership? Where will we buy the right to protect our stock ownership at if we bought the stock at 100? Close to 100, correct. We're going to buy that right to protect the stock at 100. Because if the stock loses $50, we can sell our stock up here at 100. We'll sell our stock at 100. We'll buy back in at 50, or we'll sell our long put that's at 100, and we'll make $50 on it to then buy a second share of stock. What does it look like in the real life of things? We buy a second share of stock. Our cost basis or our break even is now 75. We no longer have to wait for the stock to get all the way up to 100. We only need it to get up to 75 to break even. If it does get up to 100, I'm sorry, this is with the puts. We get to buy a second share of stock. Look at how much interesting it is. Our break even is not significantly, doesn't have to get up to 100, doesn't have to get up to 75. It might only have to get up to, in this cost basis with 280, it only has to get up to $50 and $51.40, right? We just got to make up the cost of that long put. And we're back to making some pretty good money. These two classes that Jeffrey taught last week are recorded, and they are in Safe Option Strategies. Safe Option Strategies is the education Evan bought for the Bybee group. 2 new classes were taught last Monday that are in that education. You're logging in your password you receive via email. You can literally go in there and review these 2 classes anytime you want to. It's the level 3, class 1, or module 1, module 2. And Keeve, that 280 that I had, yeah, sorry, Keeve, I was on the wrong slide. The cost basis was not including on the previous slide the cost of the puts. Any questions for today? Do you have to log into SOS? Yes, you do have to log into SOS. Check your emails. There was most likely an email from Jeff, but Emily, you've got my phone number. If you can't find that, would you please give me a call and I will have it resent out to you. Plus, I owe you some time to spend on earlier that was there. And Emily, make sure you check your bulk or your spam email in case they might have been going in there. But if you never got it, let me just give Jeff a call and I will get that resent to you. Piece of cake. It may have come from Dave Westlake, Dave W. at SOS, at Safe Option Strategies. It may have come from info, support. I'm not sure how they use it there, to be honest with you. But I'm going to have them resend it to you here today. Keeve, wouldn't you want to sell the stock at 100 and buy it down at 50 and then sell a put option for 50? Okay, so Keeve, the short answer is sure you'd like to, but the thing in real life, you can never call tops or bottoms. If you go to my last chat session, I found an interesting article that if you think you're going to sell the price and buy back in at 50 and just hold your long put, you have to be right twice. You have to be able to pick the top on when you're supposed to sell it, and you've got to be right on when you buy again at the bottom. So an ideal world that you can now outguess the stock market, selling at 100, buying back in at 50 at the absolute lowest price it gets down to would be ideal. Is it realistic to do in the stock market? It's actually impossible. If I could do that, we would all mortgage everything. We'd pick Denver to win the Super Bowl by 7 points, and we'd retire filthy rich and never have to work again in our lives. So because we can't predict tops or bottoms, we protected earnings. We do the best we can on thinking when it's at a top and when it's at a bottom, buying protection to protect profits, and we take it off when we get our technical crossovers or when we think we're at the bottom. Unfortunately, boy, in the last month, Disney never should have fallen below 115, especially with the start of Star Wars. Should never have fallen below 105 and 100. It broke both those levels of support. I had to get protection back on at 100 because that's a scary position to look at. Emily, on the technical analysis, how long in the time period to get 3 crossovers? There is no how long, Emily. There's no such thing as how long. We don't know how long. We just literally are looking for crossovers. You are looking for the crossover, and then it happened way early. Those are the 3 crossovers that line up. When you get all 3, you are good to go. But there is no time period. We don't know how long it's going to stay bearish till it looks like it crosses back over again. There is no way to know when it turned bullish. Hey, it's going to stay bullish now for 1, 2, 3 months. There is no time frame or way to guess that. You're just looking at past history and seeing what the stock does. All right. Jeff Davis, in this case, we want to buy more. A stock would come in that's lost 50% of its value? Most definitely. If a fundamentally sound company, going back to your research, if it's fundamentally sound, it's lost half its value. It's like getting it's like going to a store and getting a shirt at 50% discount. The stock market's the only place when stocks go on sale that people run for the exit. So most definitely, if it's a good fundamentally sound company that just has a bad quarter or two, has a bad analyst that's writing stuff against it, definitely you want to buy more of the company when it's down low. And what time periods am I looking at? I'm looking at the 5 and the 20 exponential, the exponential moving average. They call them EMAs, Emily, because that gives you a little slight advantage by a day or two over simple moving averages on seeing your crossovers. The exponential gives more time period or weighting to the most recent couple of days than the others. And yes, the crossovers have to happen. Crossover, not quite crossed over. On Home Depot, we do not have our crossover yet. It still is technically bearish. Yes, use your exponential, not the moving average. Yes, like Bear Stearns, you just keep adding protection as it falls. What does the volume on the bottom and the average volume? Pretty easy. The average volume is most easily looked at more at the top. You see 2.14, but you just want something with more than 1 million of average volume. Obviously, when this is trading at the 2.5 to 5 to sometimes 10 million, it's going to be above the 1 million average volume. 1 million of average volume just means that there's liquidity, that if you wanted or had to sell it, you could find buyers on the other end. All righty, any other questions? I am looking for the RSI to cross over 50, Emily. Right now it's sitting at 53.34. It's a crossed. Where I don't have my crossover is my exponentials. But it looks like Home Depot is crossing over. Reason why is because they report here in a couple days. So, or maybe they had a reporting. I don't know. I usually don't trade Home Depot. I just have it because it was a question asked in a previous class. But technically, you do not have crossovers yet on Home Depot. You'll probably get it in a day or two. Or it hits it and it might fall back down. The market might drag Home Depot down farther. You never know. All right, guys, I'm going to get this online for you. I will have a link for it to you today. Emily, let me get a hold of Jeff so I can get back into that SOS. And I want to pleasure to have you guys with me today. Again, we're taking some baby steps here. I hope this is helpful. The neat thing is on just the dummy account that for the Bybee education we set up $2,300 on a 4% drop on the stock market. You guys are doing pretty good. Pretty good. In fact, my expectation, you're going to see Disney come roaring back up to 110, 115. You guys will be looking even better. All right. Hey, you guys have a great day. I will talk with you all later. Unless there are any other questions. Does it have to cross over the 50 or down to be a crossover? Yes, Emily. On your RSI chart, you do need it to cross above the median line, the 50 line, or below it to be a buy or sell. And remember, kind of interesting, it's a 14-day average. Where it's up right now just a little bit by 3, as the next couple days come in, that might change to actually hitting it and coming back down. But it is a 14-day average. All right. Hey, guys, have a great week, and I look forward to seeing you again next week. I do have a midweek chat session, which is at 5 o'clock. On Wednesdays, you will see that in the Safe Option Strategies education. Guys, have a great week. I look forward to seeing you. And Dave, we need to look at here in a week or 2 weeks actually, 2 or 3 weeks, still possibly going ice fishing. You guys take care. Have a good one. Bye-bye.